brought you on because Joe was on a couple weeks ago, and yeah, he was talking about his portfolio. Maybe about a month or two ago, we had him on in this segment, and it's just like, yeah, he's a young investor. He works for Curzio Research. He also has his phone rescue shirt on because it's my other business, which he helps run. But he does a lot of the social media. He books a lot of the guests for me. You know, he's always looking at ways to improve our social media presence and videos and things like that, and just, you know, watches the biggest influencers out there. But just a tremendous help, because that's what I want to do in our business, is really get young people to. That's how you really grow your audience, right? In this market where you have to see what attracts the younger generation of why they're listening to certain people and not others. But anyway, we talked about your portfolio, Joe, and it was interesting because you said that, you know, you did have a lot of winners. Right. Things were going good. You're buying call options. This is when the GameStop frenzy was going on at the beginning, and yeah, you were doing pretty well. But I asked you about your portfolio this week, and you know, it's so cool that you're coming on to talk about this. It's important because, you know, it's for young investors out there, and I get a lot of emails about this. And one of the things I said is I can't teach young investors right now because they have to go through the emotions. They have to get their ass handed to them. And that's something I can't teach you, because I can't tell you, hey, here's how you make 10%, 20% annually, or, you know, whatever, depending on what the market conditions are. And when you're making, you know, 100, 200% in a week or so, right? Just on options and trades. So tell me what's going on with your portfolio, because I know it was doing really well, but when I spoke to you, tell us what's going on now.
Yeah, right. So as I guess a portfolio update from last time, a couple weeks ago, I was more into options. And then now I totally shifted gears and I'm more invested in shares. And right now in 11 companies, my entire portfolio is red. You know, the market took a dive last week and now it's a little, you know, on my portfolio is dipping again. At that time I had $10,000 in this portfolio. I made, you know, another $2,000, took a chunk out because I had a big purchase. So now I had $5,000 in here. And now my account value is at $2,500. So pretty much half of it's wiped, just the losses, which I don't plan on taking a loss on any of these stocks. I'm not going to take the money out. I'm planning just to wait till it's green, like even if it's $1 of profit, take it out, and then, you know, I'll shift gears back to maybe a mix of options and stocks, but everything's red currently. So
now it's interesting because there's a lot of things that you said there that I want to cover here. Mm-hmm. And one of those things is, you're not going to sell any of these things.
Nope.
Why aren't you going to sell them?
I'm not taking a loss. I'm not going to just shave off half my portfolio for just because of the timing of it now. I'll just wait an extra. I mean, hey, if it takes a month, 2 months, a week, a day, an hour, whatever it is, I'll wait till it's green. Or somewhat where it's not 50% loss. It's like 10%. I'll be like, all right, now I can allocate that money somewhere better, you know, and see where that goes.
Now, what happens if they go lower?
If they go lower, I mean, you know, excuse me, they're not options. They're just, you know, regular shares. If it goes lower, I can wait, you know, but most of these already have a 30% loss or a 10% loss. One of them is like around 60%. If it's really damaging, where, for instance, like Ajax, the SPAC, it's run by a lot of big names. The Chipotle founder, the Square founder, Jack Dorsey's in it too. You know, it's a pretty good mix. I bought that at $11.50. You know, I put $1,000 in it, and I'm only down like $22, whatever. But that, you know, it's a SPAC, so I'm not worried. But unlike that, where it's, you know, like say Whole, another SPAC, that I'm down over $200. If that SPAC doesn't fall through, then that's it. You know, that's gone.
And a lot of these stocks that you own are all really aggressive stocks, right? These are all aggressive
Correct.
names, ESG Holdings and stuff like that, like Plug Power. And I said, you know, what are some of the stocks that you would like today? Because you really can't purchase anything today, you said.
Even like last week, I was looking, I was like, it's a great opportunity to buy, but I'm not going to take a loss and use that money and then risk that money again. So yeah, really, I loved even Apple too. I thought it was great last week. Apple, I would have put a call option on that. AMD, same with that. I would personally buy NEO shares if I had the money. Same with Plug in CCIV, the Lucid merger. I think that's a great price, even though, you know, it was just at $60. I think it nicked pretty much almost $70. And now it's trading at what, 25, 20, 30, somewhere around there.
So when you're looking at all these names, Joe, and I want to go over, because I just want you to explain everything to because you were listening to me and you said that, you know, because you listen to the podcast all the time.
Right.
You come here and listen to them as we're taping. We tape, you know, mid Wednesday afternoon. And this gets published at the end of the day. So if we're talking about Bitcoin, it could be $10,000 higher, right? In 4 or 5 hours or whatever. But you're in here because you listen, because we blast this out to social media networks and cut it and cut different things that are whatever. And one of the things you said is, hey, you know what? I was listening to you, Frank. And, I talked about the past couple of weeks and I said, why you need to diversify. And you were funny because, what did you say?
I got molested. Verbatim molested last week. But it's true because I'm really in tech stocks or like EV stocks, like SIRC that was a partner with Tesla for solar panels and roof, like all those type of kind of small cap stocks I'm into. I'm not in any other sectors. So pretty much when the tech stocks crumbled, like that's pretty much my whole portfolio is tech. I don't have anything outside of that. So I didn't really understand the whole meaning of diversify. Like, everyone was talking about it. I was like, you know what? Like, I didn't put it into an account when I was kind of researching the stocks, and then now it's hurting me. So it's definitely a valuable lesson to learn.
So what would you do differently now? Because when I told you that, it's hard to teach you, you're like, I want to learn about stocks. And I'm like, it's really hard to teach you, actually. It's not the easiest thing to teach you. So I'm like, if you really want to learn about them, you have to go through the emotions of, it's not just having losing positions and learning and risking, because options are extremely dangerous because a lot of them, again, you could hedge yourself, but it's all or none. And if it doesn't work out, you could have the thesis on a stock that's $10 and say, hey, I think it's going to 15 and whatever. You price the options out 3 months and they come out with a bad quarter, thing goes down to 6, 7, you're done. That's and it. 6 months from now, I think it could be 40. So, you like a stock and you love it, you want to try to realize those catalysts, but you never know what's going to happen in the short term because now you're bringing in market conditions. Oh, you bring in so many risks, right? Tons of risk you're bringing in. It's like, what do you do? You have all these risks. What do you do? I mean, it's crazy. It's like, okay, for me, when I look at this, Joe, I see a lot of the mistakes, but what are some of the lessons that you learn the most? Because one of the things I'm gonna say and critique, I don't want to say criticize, is holding losers is the worst thing you could possibly do. Why do you think that is?
I know it's definitely a bad feeling. I mean, these were not losers a month ago. Everything was green. It's just the market took a turn and I can't control that. I didn't foresee this, nothing's going to stay green forever. With the options tradings, I usually try to put a stop loss on it because after I lost big on one of those option calls, I'd set a stop loss like 5%. So even though I'm risking like, say the premium was like $1,600, 5% of that for an infinite gain or, like I'm looking for a 50% gain, so I'm really managing my risk, but I kind of got out of the option game for a little bit to try investing, and then everything's red for now, but in the future I'm definitely I think everything's going to come back. I'm not too worried, but psychologically it's like it messes with you a little bit, but this is what the stock market is.
So are you familiar with stop losses?
Mm-hmm.
Okay, one of the things with stop losses is no perfect system, right?
Yeah.
I feel like for me, my greatest thing is being able to find discounts. Sometimes I'll be a little early on them, but selling them is always tough, right? Because you never really know when to sell. You can't really sell based on valuation. You want to let that momentum go. But
right.
What the greatest investors do is they always maximize their upside potential. So if it doubles, maybe they sell half and they still own it, right? They lower that cost basis to 0, which basically means that, you bought the stock at 10 and went to 20, you sold half, you took all your original money out and you're good.
Mm-hmm.
Outside, not including tax purposes. So now if it comes down, you don't mind because you have it long term and you're keeping it. And now you sell half and you're liquid and you can get into another stock. But having stops on it, what's the most important thing? Because I've seen stocks come down, trigger. And one of the examples was Delta Airlines for our portfolio. We do very, very well across all of our portfolios. But Delta, it's a little bit early on in like April, May and said, listen, it's going to bounce back. Everyone said it was crazy. And it did come down. I think we had a 25% stop on it, and it hit it, went a little bit lower. And I think that was we might have got stopped out like 29 or something.
And then it jumped, right?
Oh, yeah. It's to the roof, like 45, 47 now. But yeah, that's the worst case scenario. But let's look at it from a bigger perspective. You're going to be wrong. The only person who's not wrong is me. No, I'm joking. You guys know, I cover my lose money. Everyone's going to be wrong. If it's Buffett, Buffett talked about with Precision Parts, how much he lost. You look at Ackman with the Target and all that stuff and just, JC Penney. There's just so many different, every single person has losses, But the best investors limit their losses. And when you put in stop losses, Joe, one of the things is it takes the emotions out, because once you hit that stop loss, you're out. We just stopped out of our first stock probably in like a year in one of our portfolios in Curzio Venture. And it's a name that I like a lot, and I think it's going to go higher. And I also added more. It's a personal position of mine. Again, I own a lot of the stocks that I'm recommending, right? I eat my own cooking. And now that it hit our stop, we're out of it. Now I'm okay, right? So okay, we're out of it. It's fine. The rest of the portfolio is doing great, but now we have money on the side that we could put into the market. Maybe this thing declines another 30, 40% from here. Nobody knows how much higher, how much lower they're going to go, or if the market conditions change. But now you have, some powder there where you could add to whatever positions you want, or build new positions for the next idea, whatever it is. But that's one positive feature on stop losses, Joe. Another thing is it removes the emotions. When it hits it, you're gone.
That's it.
And now you're moving on. Because right now, what are you thinking about? You think about all your losers. It's the worst, most unproductive thing, because you could have 20 stocks. If you have one loser in your portfolio and it keeps going lower and lower and you don't have a stop on it, that's the one you're going to focus on every single day. That's the one you're going to look at every single day. And you're just like, it's lower. And you might buy as it goes lower and buy a little bit more, because sometimes they don't always come back. We're in a market where young investors are used to everything coming back. Just keep buying the dips, buy the dips. Fed's going to be there, buy the dips. It's not always like that. And as you could see, right, ESG stocks, a lot of people getting in, like even marijuana stocks. People don't know most marijuana stocks down 25, 30% in a couple of weeks, right? I mean, look at Tilray, went from like 7 to 35 and then went to 65. But I know a lot of people bought it 50, 40, and now, it crashed all the way down. Which
people got hurt.
And they're actually merging with a company where, the ratio with the split in shares showed that this stock has to come down a ton based on where the company they're merging is trading at. So it was an easy short. Really no risk short for investors, and it pushed all the way lower. I wouldn't say no risk, because maybe they could push up higher, like we did with rocket companies and stuff, rocket mortgages. You saw that it's up 40%, now it's down 20% today. It's pushing around short stocks. But one of the things I would suggest, Joe, is definitely stop losses. Use them, because it takes the emotion out. That's the biggest thing. You're out and that's it. And trust me, you're going to be really wrong on a stock where it triggers your stock. There's stocks that triggered, my thesis didn't work out, took a 25%, 35% hit. And I've seen those stocks decline by another 50, 60%, because management just wasn't getting done and whatever. And instead of me being in the stock the whole time and looking, I go, what the hell? Management sucks. And what are they just complaining, going crazy? I'm buying the next idea that I like, which, I'm fortunate to be in a position with my network where I get lots and lots of really new ideas and get into trends early and travel around the world. But that allows me to invest in new situations,
right? Which
is cool. Another thing, too, is don't be afraid to take a loss. You don't know if they're going to come back. And if they don't, you're screwed. You look at it, it's going to come back, it's going to come back. Maybe you're right. Maybe it does come back tremendously. But what happens if it doesn't? Now you're sitting in your portfolio. Again, there's a lot of things that are working. Travel-related stocks are working. Cyclicals are working. Energy's working. Financials are working. And you're in a sector that you bought near the top that's coming down. Another thing, Joe, is the option part. Options, I mean, I'm not going to say this and put an age on it, but really, if you're under 25, or if you're a new investor with less than 5 years experience, don't buy options. Mm-hmm. You could buy covered calls or whatever, but options, I mean, you're playing against Wall Street elite, and they are going to take you and throw you out, spit you out. You'll have one sock left, and they'll take the sock off too and say, nope, you got. That's Wall Street.
Yeah.
I worked there. That's how they are. They kill you. They crush you, and they have a lot of money. And I know we have the Reddit crowd going, wow, look what we did to Melvin Capital. It's $12.5 billion. It's $1 trillion industry, man. It's a huge industry. So, a lot of lessons there, a lot going on. But I really, really appreciate you coming on and telling me this, because I know there's a lot of young investors have the same problem. But the only way I could teach this, Joe, is by you going through the emotions of losing that money, right, having your tail between your legs and understanding the risk, because those mistakes, what you don't realize is the best thing that could happen to you. You're in a great position. I mean, the greatest lessons that you could learn is you learn them from your mistakes when you're in them. That's what life, that's investing, that's what everything. Because then you get better, you get smarter. Mm-hmm. And that's the goal. We're still going to make mistakes, investing. I'm still learning something new every day. That's why I love what I do. It's always a challenge. It's like golf. If you shoot a 59, you're going to try to shoot a 58. There's no satisfaction. You can't be 100% right. And that's why it's the most competitive sport ever. But learning from your mistakes, Joe, and just understand that you have tons of working power. Hopefully you're going to be an analyst here and learn a ton. But at this stage, now it allows me to teach you a little bit more. And now that you went through that process, and I know a lot of people, and I went through the process. Major hedge fund managers that you hear on TV went through the process. Yeah. Everybody went through this process. It happens to everybody, and you learn from it. There's not a billionaire investor that's going to tell you that at the beginning they didn't get crushed or didn't. That's how you learn. That's how you smarten up. That's how you invest. And learning this at such a young age, guys, don't get discouraged. If your portfolio is down and you're getting, use it as, hey, this is what I learned, but stay into the markets. Try to stay into the markets. Try to learn from your mistakes. Don't get discouraged and say, stocks suck, I'm never going to go into it again, because they don't if you invest right. And that's something I could teach young investors, but I can only teach them after they go through this process. So not that I'm happy that you lost money, but you see the impact of it, right? And it's just, it's something now we can go back and say, here's what you're doing wrong. Put stops on it. Big deal. If you hit a stop, you have your money. Now you can buy it, whatever you want, or it comes lower. It's just, especially with the options and putting a time value, you don't know what's going on with the market. Say if the stimulus doesn't go through. Say we saw interest rates rise tremendously, long-term rates, and push the market down. What if they continue right? You don't know what's going to happen. You don't know if we're going to go to a war. You don't know North Korea launches a missile that comes close to us, whatever. But when you have options, you bring all that into play when really it's not a long-term concern, as long as that nuclear missile doesn't hit us. It's not a long-term concern. But that's the biggest lesson I could teach you about that. But, I want to thank you for coming on, Jay. It means a lot because, and I said that I'm not bringing you on to Chris. I'm trying to bring you on to help you. And I told you beforehand, I said, are you okay with this? You said, absolutely, because I want to learn. And I think this message resonates with so many young investors out there. And for you young investors, listen, the best thing I could do to try to help you out is listen to this podcast. And it is absolutely for free. You listen to the podcast. We have it on iTunes for free. We have it on a Curzio Research YouTube page, all the videos and everything for free. You're going to learn a ton. I cover my losers more than my winners. And I also have great guests who I vet, which, is my job to make sure I'm putting good people in front of you. And then if you want to start a package, you would go to a $1 Stock Club, which is $4 a month, where we take a pick from, each week from our investor. And it's cool because these are picks that might be new to my audience because these are from my guests, not specifically from me. And I cover all sectors, but sometimes they'll come up with stocks. I'm like, wow, this is pretty cool. We'll do a 1-page report, provide a stop loss on it, a buy up to price. And it's $4 a month, and you can cancel 1 month if you hate it, but you're getting new ideas. You're seeing how the research goes. That's our goal, to try to teach you, to get you into a very low price products, not going to hurt you. You also have free trading with so many apps. But that whole process, that's how you become a better investor. And again, Joe, I just want to thank you for coming on because it means a lot, man. You got to be humble.
Thank you.
But I really think for any young investor listening to this is they'll make sense out of it because they feel the same way. I'm holding these forever. No stop losses, options. This is a long-term gain. When you're 50, 60, you want to have a massive portfolio where you're just earning whatever returns, 7, 8, 9, 8%. People don't know 8% returns, Joe, have been earned. If you bought the S&P 500 in the 50s, when it first became 500 companies, annually, those returns with dividends are 8%. That is unbelievable. You try putting 20 grand or 10 grand and just put in a compound calculator for 20, 30 years. How old are you?
I'm 21.
All right, 21. 30 years, 51. I'm 47. You're going to look like me, which is bad. That's going to be bad for you because you kind of look a little bit like, you're going to look worse.